When equity markets fall, as they did at the beginning of this year, it's a good time to step back and focus on valuation. And that's for two reasons. Firstly, it tells you how much further markets might fall before valuation starts to support them, but also you can work out when you're actually bagging a bargain. Now, of course, the price is measured relative to the fair value of an index. So in this video, we're going to look at multiple models. It's always a good idea to do that comparison. So let's look at valuation in a bit more detail. Let's start off by looking at what we mean by fair valuation. We can decompose the price of any asset into two components. The first one, which I've called fundamentals, is based on a rational pricing. So for example, we might look at how many dollars people are willing to pay for every dollar of profit which a company generates. That's all based on quantifiable things. The second component, which is harder to quantify, is to do with psychology and sentiment. During certain periods of time, like now, people are willing to pay much more for every dollar of profit, say, than they would be during a depressed market. And we usually call that irrational exuberance. And this is why Warren Buffett talks about Mr. Market. Sometimes Mr. Market's euphoric, and he's willing to pay you much more for the same fundamentals. At other times, he's really depressed, and he's not willing to pay much at all for the same fundamentals. But while exuberance is very volatile, it comes and goes, fundamentals are useful because they tell you where markets will eventually go back to. Here's one of the measures which I like best, which is called the forward price to earnings ratio. This measures the price of the S&P relative to the forecast profits for all the companies in the S&P. Now, what I like about this is that the forecast earnings adapt to all available information. They're based on broker forecasts, which factor in everything which is known. This is also a forward-looking measure because it's based on what we expect in the future. And generally, equity markets are forward-looking. So that's why I think this is a great way of looking at what equity markets are worth. So what you can see here is how many dollars people were willing to pay for every dollar of forecast profit going back to 1960. You can see that the line swings hugely from the average value, which is around 15 times forward earnings. So if you look at the dot-com bubble, people were willing to pay over $26 for every dollar of profit. But after the dot-com bubble burst, that went down to the average, which is about 15 times. And then we got the financial crisis, and the multiple went down even further to about 8 times forward earnings. You can see that currently, valuations are very, very high relative to history. Another useful aspect of this forward price to earnings ratio is that it's mean reverting. When there's a wave of euphoria, we deviate above the average price to earnings ratio, and when markets are depressed, we deviate below the average. But notice how always we come back to that 15 times multiple. Unfortunately, we don't know when that's going to happen, so valuation doesn't tell you anything about timing. However, when markets do sell off, you know when they're relatively cheap. So for example, in March 2020, we knew that valuations were below their average. So that was a good time to buy equity. Similarly, during the global financial crisis, you can see that was another great buying opportunity. What you can also see is that the latest valuation at the end of January 2022 is still very high. So that's a 21.1 times forward earnings multiple. So if we look at the fundamentals, you can see that the 15 times earnings is nowhere near where we are now. So if we decompose the price today, you can see the fundamental component is 15 times earnings, that's the average, but we're also paying a roughly 6 times forward multiple based on exuberance. People are just excited about equity markets and willing to pay more than usual to get the same amount of profit. So immediately you can see that if the exuberance fades, we'd lose a 6 times multiple on the S&P, and that would take us back to a 15 times multiple. And this is the first reason why we look at valuation. It tells us how far markets could fall till we get to a fair price. So what does that mean for equity markets right now? Well, the forecast earnings for the S&P 500 over the next year is just over $220. But the question is, which multiple do we use to work out the fair value for the S&P? If we use a 60-year average, which is what we saw on the previous graph, that puts us at a value of 3360 for the S&P. That means that if we fall from the high at the beginning of the year, we've got about 30% which we'd fall. So for the S&P, if we're looking at just getting back to the fair price, we'd look at a fall of between 14% and about 30%, depending on how far back you look at the average multiple. But what usually happens is that markets panic. People don't just sell off to the fair price, everyone steps back from the market because they're terrified. So for example, during the pandemic, the multiple went to about 13 times forward earnings, which at today's earnings of $224 would put us down about 40% relative to the peak. And if we went to a mood of utter despair, as we did after the global financial crisis, the multiple went down to 8 times forward earnings. And that would put the S&P below 2,000, and the fall would then be 60%. Now, the bigger the fall, the less likely it is. Most of the time, markets fall by a certain amount, and lots of buyers step in. However, sometimes people just get spooked, and we go down to these kind of depressed valuations you can see at the bottom here. But what's great about valuation is that it shows you exactly how bad things could get. And my guess, which is that fundamentals are still okay, would be that we'd get down to about a 30% fall, and that would be a worst case. Valuation is something I discuss a lot in my free weekly market roundup. If you want to keep abreast of what's going on in markets, but also how economics interacts with markets, and also have a funny tweet, usually it involves a dog, then you can learn more about that by clicking on the link beside me and in the description beneath me. Now, interest rates are currently very low. So is that relevant to valuation? Well, yes, it is. What kind of interest rates are we talking about? Well, usually we think about something like the Federal Reserve's policy rate. That's the federal funds rate. And even though the Fed's talking about raising that 3 times in 2022, it's still very low by historical standards. Now, these interest rates are usually called risk-free rates because when we lend money to the US government, it comes almost risk-free if it's a very short-term loan. And that means that people are forced to go into more risky assets in order to generate return. So when rates are low, that pushes up valuations. People are willing to buy riskier things, for example, equity, emerging market equity, or crypto, say. Now, Robert Shiller, the Nobel Prize winner, came up with a brilliant valuation measure called CAPE. That's a cyclically adjusted price to earnings measure. What that does is it looks at the price of the S&P relative to earnings over the previous 10 years. Why 10 years? Well, that's roughly a business cycle. It turned out this was really good at spotting bubbles in the S&P. However, it remained at very high levels for a very long period of time because over the last decade, interest rates have been almost at zero. The Fed's policy rate has been close to its zero lower bound. So Robert Shiller adjusted his valuation measure to create something new called excess CAPE yield. Now, this is what the equation looks like for excess CAPE yield. Don't worry about the details, but it's got 2 components. Firstly, you take the CAPE measure and you invert it. So when equity is expensive, that component is low. But then you adjust it for interest rates. You subtract the 10-year real yield, which is the interest rate at which the US government can borrow for a 10-year period, but adjusted for inflation. So what you can see here is the excess CAPE yield going back to 1880. As published by Robert Shiller. Now, when equity is cheap by this measure, you can see that we're high up on this graph, and I've shaded the cheap times in blue. So equity was cheap in the 1920s, it was cheap again in the 1950s, those were both great times to buy, and it was cheap again in the 1980s, when people declared that the equity market was dead. The bits shaded in pink are when equity markets are expensive, so that's when the excess CAPE yield is below the dashed red line here. So for example, in 2000, we had the dot-com bubble, and equities at that point were very expensive, and that was not a good time to buy. Now currently, the value of the excess CAPE yield is not particularly high or low. Notice how it's sandwiched between the cheap line at the top and the expensive line at the bottom. Yes, equity markets have sold off, so the CAPE measure's fallen, and that's pushed the excess CAPE yield closer to cheap territory. At the same time, real interest rates have actually surged, and that's pushing in the opposite direction. So that's making the excess CAPE yield go down, and that's actually making equity look more expensive. Now, if we look out over a 10-year window, you can see that when the equity market's cheap by this measure, that's the blue bits, the following 10-year return on the S&P, which you can see in the panel above me, is very high. So when equity was cheap at the beginning of the 1950s, the following decade had very strong returns. In contrast, during the dot-com bubble, which is shaded in pink here, you can see that the following 10 years of returns were actually very poor. In fact, they were negative. So when we do adjust our valuation measure based on yields, you can see that markets don't look as expensive. That was the whole point of Robert Shiller producing this measure. But currently, even by this measure, equity markets are not a screaming buy in the United States. Another way of looking at that is a scatter plot where the x-axis is the excess Cape yield at the beginning of a 10-year period. So here on the right is when equity is cheap, on the left is when equity is expensive, and the y-axis is the 10-year return on the S&P adjusted for inflation but including dividends. So the bottom here is negative real returns over a decade, and at the top is positive and large real returns over a decade. So what I've done is I've sliced a vertical line through the data points according to the latest value of excess Cape yield, which is just a little bit under 3%. But the upper limit of return over the following decade would be around 7.2% per year, and the lower limit would be very poor at 1.2%. But really, this measure's most informative when it's at extreme values, and currently it just isn't. And that's why there's so much uncertainty in the forecast. So that's the US market. How about if we look at other countries? Barclays publishes the Cape measure for many countries, and that's what you can see in this graph. And what I've done is I've compared the Cape measure for every country relative to its own history. So what you can see here is a percentage of time each country has been cheaper than it is today. So as of the end of December 2021, you can see that the Netherlands had never been more expensive, or alternatively, it was cheaper 100% of the time. Similarly, Taiwan and the USA were very close to their all-time high valuations. They'd only been cheaper 96% and 94% of the time, respectively. The UK, in contrast, is relatively cheap. In fact, it's been cheaper than it is today 56% of the time. And if we look at the countries on the left of the graph, these are the cheapest. You can see that Singapore has only been cheaper 16% of the time. Other cheap countries are South Africa, Japan, Poland, and Turkey, but also China. So some of these countries are cheap for a very good reason, but if you are of a contrarian frame of mind, then you'd see these low valuations as an opportunity. These are the country-by-country returns in 2022, and of course everyone's focused on the US because it's such a big market, and that's down by around 8% as I make this video. Russia also has sold off quite sharply, it's down by about 13%, and Sweden's down by about 9%. But it hasn't been awful for all countries, at least not yet. So for example, South Africa's rallied quite a bit, so has Turkey after a huge sell-off last year. Now those Cape numbers were at the end of December last year, so if we adjust those Cape measures based on these returns, these are the new valuations. And to be honest, there isn't much difference. So the US started off expensive, and it's still expensive. It's now been cheaper 91% of the time, rather than 94% of the time. So if we think in terms of long-term valuations, there really hasn't been that much of a shift so far. In summary then, I'd say don't panic. As always, you don't want to sell when equity markets are falling, but valuations are still above fair value using measures like forward price to earnings, say. If we look at excess Cape yield, things look at roughly fair value. So it really depends on the model which you use. But I think there's very clear signs that in other markets, other countries other than the US, valuations are quite reasonable. So if you are willing to be a bit contrarian, you could always take a punt with those markets. Now remember our offer about our weekly market roundup. I try to keep it punchy and entertaining. I hope you enjoy it. And of course, it's free. Now, if you do want to learn more about that, just click on the link beside me or in the description beneath me. And as always, thank you for listening.